I am not bullish on the US bank system. In fact, I just sent out a tweet and ran some quick math on PacWest. PacWest has a market cap of less than 700 million right now.
Right.
It's got $44 billion of loans outstanding, assets. So you can calculate what that leverage is. It's about 63 times, okay, to its market cap. It's leveraged 63 times to its market cap. That basically means assets, if they change by more than 2% or 2 out of $100, it's over. It's already over for PacWest.
Greg has spent over 30 years in financial markets with a focus on trading high-yield credit. He was a founding shareholder at 3iQ, one of Canada's largest digital asset managers, and is currently CFO and Bitcoin strategist at validuspower.com. According to Greg, we live in strange times. Central bankers tell us up is down. Politicians peddle myths. And the seeming robustness of capital institutions and the state is turning out to be a facade. And yet the economic machine needs to keep running. Finance needs to generate a return. What is the fundamental issue? Arguably, it is that the whole framework of state-organized economic control is falling apart. The impacts are manifold. Price and value have no real meaning. Reasonable returns on investment are evaporating. Financial opportunities are being drowned by risk. The real concern is that confidence is rapidly ebbing away. The fiat economy is fundamentally a confidence engine. Trust has replaced hard assets. When trust goes, nothing is left. We now live in a world where disillusioned experts are telling us the game is up, state debt is unmanageable, and governments have no obvious solutions. This is why many such people are turning their attention to Bitcoin. When we're facing QD infinity by zombie countries, it is wise to go back to the first principles, sound money. Let us now join Greg Foss as he succinctly discusses the credit contagion debt spiral, implications of a global reset, interest rates, and debt ceiling. Sit back and enjoy the video.
Just based on economic indicators and the like, and the high likelihood that we will see some sort of credit contagion, I believe that at least one rate cut by December. So I'm hedging my bets quite a bit, but a lot of people say no rate cuts all year. I'm on the other side of that. I think there'll be a nominal rate cut and QE infinity. That's the more important thing, is that they open up the printing press again. We have gotten to a point where the debt spiral, the total global debt, and I won't just focus on the United States. It's not in isolation. The total global debt numbers are so large that the organic growth of the debt, because of the coupon, will exceed the will exceed the growth of global GDP to an extent that the interest expense makes the debt expand. The only way of solving that is by printing. There's lots of ways of the terminology, but all fiats debase, Paul. That is just the math, and they are relative. So they're all debasing. Just the rate of decay is different between certain nations, depending on things like, obviously, interest rates and trade deficits. But they're all debasing. So we know that for sure. Some are debasing faster than others to enhance their competitiveness in a global market. It's called beggar thy neighbor. If you debase your currency more quickly, the currency makes your exports more attractive. And as you know, GDP is measured as follows. GDP equals consumption plus investment plus government spending plus net exports. So that net exports fourth term is quite a, it could be a, it's a term that they can play with a debasement of the currency, makes their exports more attractive. That being said, a CBDC is nothing more than a digital fiat. Yeah. So if you're doing it with analog fiat, you're going to do it with digital fiat. Yeah. Now, the digital fiat comes with an added bonus of surveillance and monitoring. And Mr. Foss, you spent your money on a parade, at a restaurant on a parade route that we don't agree with. So you were obviously attending that parade. We're going to censor your CBDC, or let's take it to another extreme. Mr. Foss, you're a fat man. You're a fatso. We are going to limit your caloric intake because we've seen that you're shopping too much at a restaurant. All of these things are possible. Let's not go there. The reality is, though, whether it's an analog fiat or a digital fiat, they're all going down. I mean, let's not overthink things.
President Joe Biden and top lawmakers agreed on Tuesday to further talks aimed at breaking a deadlock over raising the $31.4 trillion U.S. debt limit, with just 3 weeks before the country may be forced into an unprecedented default. After about an hour of talks in the Oval Office, Biden, a Democrat, and House of Representatives Speaker Kevin McCarthy, a Republican, committed their aides to daily discussions about areas of possible agreement as default looms as soon as June 1. Greg Foss shares his views regarding the debt ceiling. Let us hear what he has to say.
Interest rates have been on a one-way decline, not for the last 14 years, but for the last 40 years. When I started trading in the late 80s, interest rates were double digits, okay?
Yep.
And essentially they've gone down, and when they go down, bond prices go up. As you know, that's the price-interest relationship in bonds. When the Bank for International Settlements created in the late 80s, early 90s, primarily, I guess, early 90s, the Bank for International Settlements capital guidelines, they were focused solely on credit risk, okay? Interest rate risk was not a huge focus for them. Banks are viewed to be lenders, and the largest risk in lending is credit risk, not interest rate risk, because most loans don't have the duration of long-dated treasury bonds. But you see, Paul, in that, long-dated treasury bonds had a capital requirement of 0, which means a bank could take your deposits and essentially lend to the U.S. Treasury, short-term deposits lending to 30-year treasury bonds. As long as interest rates go down, that 30-year bond goes up in price. Everything's hunky-dory until interest rates go up and that bond price goes down. And that's what we're living through right now. So, correct, they haven't measured for it from a capital allocation. Doesn't mean that risk didn't exist. It's just that the regulators were focused on other things. And by the way, they barely had enough capital to cover their credit risk exposure. The regulators didn't want to bring in interest rate risk exposure. It would have required all the banks to go out and raise more equity capital, dilute their shareholders, and cause, a ceiling on bank stocks. That was not their goal. The capital guidelines were largely, and I worked on the capital guidelines for Canada's largest bank, Royal Bank of Canada, in the early 90s. They were reverse engineered. The banks had a certain amount of capital, and the BIS regulator said, well, let's reverse engineer these credit guidelines so that you already keep the amount of capital that's on the bank's balance sheet. It's such a goofy system. It really is pathetic. And it was largely a response to the Latin American debt crisis in the late 80s that they brought these BIS capital guidelines in. Guess what? Now we're living the regional banking crisis, same problem.
Right.
Though their equity capital has been carved because of interest rate risk, and we haven't even started contemplating the impacts of commercial real estate and real credit risk. It's not good.
Credit risk expansion comes with increased risk for regional banks, particularly if they are not adequately prepared to manage that risk. If a bank extends credit to a large number of high-risk borrowers without appropriate risk management practices in place, it may experience higher levels of loan defaults and credit losses, which can negatively impact its profitability and financial stability. Greg Foss throws more light on this and further talks about zero hedge and interest rates. Let us continue with the video.
Interest expense on the debt that's going to become the largest item. What's the total government debt is over 30 trillion. Interest rates are 3%. That means that the interest expense portion is growing at over $1 trillion a year, right? 30 trillion times 3% or 3.5%, which is the US 10-year rate. That's interest expense. Then you add on entitlements, and then you add on military spending. Biden's not going to cut the deficit by $3 trillion. It's mathematically impossible unless the USA wants to go into deep depression, because, again, I'll throw out the equation of the day. GDP equals consumption plus investment plus G. What does G stand for? Government spending. Okay, cut that down. And all of a sudden, everything else, GDP contracts. And as a portion of your debt burden, you have contraction in your GDP because of government spending, it's over that way. So either it's over because of the consumer, it's over because of net exports, it's over because of government spending. It's over, people. Like, I don't know why we're splitting hairs and trying to thread this needle. So the only solution is continue to print money. The deficit is out of control. You will never bring it back into control because we've lost that ability mathematically. And just a little comment on Secretary Yellen there. I mean, all due respect to a nice old lady, she's got to go. Grandma, you're not doing anybody any favors. Go out and start watering your petunias. Get somebody in there that actually is honest and credible and can actually do mathematics.
The White House and Republicans in Congress are mired in a standoff over the debt limit. Failure to raise or suspend it could result in the first ever U.S. default. Treasury Secretary Janet Yellen has warned that the U.S. could run out of money to pay its obligations as soon as June 1 if Congress doesn't address the matter. Defaulting on sovereign debt would wreak havoc on the economy and royal markets around the world. A default on Treasury bonds could throw the U.S. economy into a tailspin. The last time congressional Republicans threatened a default in 2011, Standard & Poor's downgraded the U.S. credit rating for the first time to AA+ from AAA. If the U.S. were to default, gross domestic product would drop 4% and more than 7 million workers would lose their jobs, Moody's Analytics recently projected. Even brief default would lead to the loss of 2 million jobs, according to the data. In that scenario, U.S. bond ratings would be classified as restricted default. According to Fitch Ratings, and Treasuries would have a derating until the U.S. could once again borrow. The Brookings Institution noted a default could lead to $750 billion in higher federal borrowing costs over the next decade. What's more, a default would shake the U.S. position on the world stage. U.S. Director of National Intelligence Avril Haines told the Senate Intelligence Committee last week that Russia and China will take advantage of the U.S. potentially defaulting on its debt. Haines warned the two nations would attempt to highlight the chaos within the United States that we're not capable of functioning as a democracy. We are yet to see if any of the parties will budge as June 1st draws ever closer. We hope you enjoyed the video. Don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.